How much money do you need to retire? Can you safely retire with whatever amount you have in your head? There's a formula for that we're going to consider, and we're going to keep in mind that just because we have a plan doesn't mean it's going to work. So we're going to account for that too. Theodore Roosevelt said, "Comparison is the thief of joy." Others have said it in different ways, and generally speaking, I find it's pretty accurate, but from a planning perspective, I've always considered comparison part of my research. Now, the difference between what does somebody else have and what has somebody figured out through experience, it's pretty different. It depends on whether or not you use it. You either use it to create a goal, plan to get to your own safe place, or you just compare it to what you currently have or don't have. Proof Teddy right? Let that steal your joy. I think we can do better than that. Now, the reason that I mention comparisons is because we're going to look at a plan that involves some numbers. And the numbers, well, they're not specific to me and they're not specific to you, and we need to remember that part. The important part to each of us individually is the formula. Now, the plan is called the 4% rule or the 4% strategy, and it's one variation of a plan that involves retiring on interest accrued from an investment portfolio. So 4% of $1 million would allow you to withdraw $40,000 for living expenses, and that would supplement any other income that you may or may not have. Social Security, pension, whatever. Now, if you find yourself thinking, I don't need $40,000 to pay the bills, or I need a lot more than that to retire, well, you're getting caught up in the numbers. You need to zoom back out and just pay attention to the formula. And this video is also going to take a look at the practical possibility that it might not always work. So let's get a quick shout out to channel sponsor Summit Metals. If you're looking for gold and silver, they have it. They have great prices, fast shipping, and great people. SummitMetals.com. So let's get back to this formula. This is a gold channel. So some of this might seem strange for a minute while we talk about the 4% rule. Now, don't worry, we're going to come back to this gold in a minute, but the 4% rule is a popular retirement strategy where you withdraw 4% of your portfolio every year, leaving the remaining balance invested. That allows it to continue to grow. So this is infinite money supply. You live off the interest from your retirement portfolio without draining the capital. Now, I'm not going to go into all the details of the strategy, and like I said earlier, this is going to vary wildly person to person. I'm also not a financial advisor, but I will say that I plan for something similar to this in my retirement, and so do a lot of people to certain extents. Now, if you're one of the younger viewers here in particular, I'm going to tell you that I wish somebody explained this to me earlier. There's no rocket science to this, but it really changed my thinking. And just generally, I find that if you have a goal, you're far more likely to get further down that line. So let's just get into an example of how the 4% rule works. If a person retires with $2 million in stocks and bonds in their portfolio, the individual can withdraw $80,000 that first year without reducing the capital value of the portfolio. $80,000 is 4% of $2 million. Now, 4% is meant as a level that allows the portfolio to grow enough to beat inflation, so it assumes an average annual portfolio growth of 7%. Now, that all sounds great, but what happens if the portfolio doesn't grow 7% in a year? Well, that's where you need a backup plan, so you aren't draining principal out of the account on a market downturn. Now, there are different ways to come up with a backup plan, of course. You could just leave cash laying around, but one way to do it might be gold. And just like there's a formula for how much you might need to cover expenses, well, there's a formula for how much you might need for Plan B. The formula, it's as simple as 2 to 3 years of the plan's performance. So if you have $1 million, it would be 40,000 times 2 or 3. So $80,000 or $120,000. Now, again, this is just a formula. It's not specific to any of us, but I have mentioned before that I don't have a goal for how much gold I need based on some specific percentage of a portfolio. I base the number off possible gaps, possible expenses over possible time frames. So not 5 or 10% of a portfolio, but 2 ounces per month over 24 months. Now, that's based on a specific amount that I might need as an emergency fund and a time frame that I might need it. Now, I use gold for more than an emergency fund, but let's just ignore that part for a minute. Okay, now if we put those two strategies together, the 4% rule and the emergency gap fund, we're basically doing what some people out there call the bucket strategy, where the first bucket is going to be cash and short-term needs, the second bucket is going to be medium-term stability, and the third bucket, because 3 is better than 2, is long-term growth. At least initially, you're going to rebalance over time based on your time horizon. So gold and cash might be in the first bucket, conservative stocks, funds, bonds in the second, growth stocks and assets maybe in the third. Now, again, let's not get too deep into this. First of all, I'm not a financial advisor. Some of you out there probably are a lot deeper into this than I am. And second of all, I'm just not trying to tell anyone what to do. But the first bucket that we're talking about here is just meant as a buffer so you don't have to sell growth assets from the third bucket, particularly during a market crash. So if you planned around the 4% retirement strategy and you needed $40,000 to supplement Social Security or passive income or whatever it is you have, maybe that covers everything you need, well, 2 to 3 years, again, would be $80,000 to $120,000. Let's just take 3 years. $120,000 at today's spot price would be 40 ounces of gold, and that's what we're looking at in this trade. Now, again, the important part is just the formula. I'm going to say it again. We're not comparing. We're just looking at the experience of others, what they've been able to do in various cost of living brackets, and then we're going to build our own plan. So maybe you want to shoot for $2 million. That'll get you $80,000, or $8 million. That'll get you $320,000. Now, I'm not here to guess what anybody needs. I'm just pointing to a strategy that's already widely used. It's a strategy that I like, but I'm also noting that strategies don't always go according to plan. Now, earlier I mentioned that I've had 50 ounces as an emergency goal. Well, I was planning for emergencies before I was planning for retirement. I don't know that that's good or bad, but as I'm getting closer, I'm starting to line those strategies up a bit, and it turns out they're actually pretty similar. Now, if you're already retired, your window for creating a retirement funded by portfolio interest is probably already closed. I get it. You probably already have your retirement strategy figured out. It's totally fine. Gold for you might mean different things. I have different gold for different things. Maybe you like to collect. I definitely have that kind of gold, and that gold is not going to be sold for the value of its gold content, so I don't have to sell Nvidia during a market correction. Whether you're retired or not, gold's potential benefit as an emergency fund hasn't changed. You're just either using something like the 4% rule or you aren't. You know what the bucket strategy is or you don't. Analytics tell me, though, the largest group of viewers by age fall into the 25 to 34 bracket. And if I could talk to 25-year-old me, I would have some things to say. First, about wasting money, and second, about compounding interest. It's possible at 25, I couldn't afford gold at all. I shouldn't have been buying it. This Marcus Aurelius Roman Aureus, way worse. It's not something that I should have been buying in my 20s. Apple stock, that was the better buy. I don't want good habits preventing better habits. That's why I was keeping it simple with quarter-ounce gold coins when I got started. That, and I probably just didn't have a lot of money. Now, gold and investing are different things to me, and the differences are definitely age-based, time horizon-based. In my 20s, I should have been maxing out my retirement account contributions, taking advantage of every penny that a company would match, and only buying gold to keep me from otherwise wasting money. But I wouldn't let that slow me down from investing. Now, as you get older, that flips. Gold might be more to protect wealth, so rebalancing away from high-risk growth assets that are more prone to market volatility or worse. That all makes sense. Now, how does this all come together, though? Well, if you still have time to put together a retirement plan, these different guardrail strategies where you live off a percentage of a portfolio that doesn't reduce principal capital, or at least it allows a portfolio like that to continue to run for 30 years, well, those are things that you should be looking into. Figure out how much you need to live off of and work toward that. Now, where gold comes in, at least for me, is in allowing a plan like that to even work in the first place. You can't always assume you're going to have a 7% return. Now, hearing that gold is plan B in all of this might seem like a little bit of a surprise coming from somebody who has a channel about gold, but that doesn't make it any less important. Now, I don't have any business telling anyone how to prepare for retirement, but I think a lot of the advice out there is just contradictory. And I rarely see any mention of how assets and allocations should change over time. Young, nearing retirement, post-retirement. Look, the younger you are, the more compounding interest can work for you and the more time you have to recover if risk doesn't work out in your favor. Really, that should be prep talk for any conversation about an investing strategy, but I never hear it. So the formula I gave is useful if you have time to build a plan around living off portfolio interest. Now, if you do, consider yourself lucky because only 10% of Americans have $1 million saved at retirement. 3.2% get to $2 million. You have to go after it to get there. And the earlier you start, the easier it is. Just ask any of us old guys. Now, the other thing that I think is important to know is that any plan can fail. I've saved gold all these years with that exact thing in mind. If you're wondering how much you need to retire, well, you can use the 4% rule or some kind of 5% guardrail rule or something else entirely. But just don't forget to have enough of a backup in place to let the plan work if the universe does something you didn't expect. So let's call it good there, and let's hear from you. If you have a retirement plan in place, whether you're working toward it or you're already living it, let us know. I would love to see where gold fits in. I think that's helpful for everybody. And then while you're in the comments, be sure to hit that like button if you found any of this interesting. Be sure you're subscribed with notifications turned on if you want to hear more on the topic. And if you're still here, thanks again for watching. I always appreciate your time. Take care.